In 1963, Buffett read one page and bought. A scandal had just wiped a giant company out. American Express stock had fallen by half. A swindler stored ocean water and called it oil. Tankers held seawater, not the salad oil promised. American Express had vouched for the missing oil. Wall Street panicked and dumped the shares fast. Everyone stared at the falling price. Buffett did not. He turned instead to one boring document, the balance sheet. By the end, you'll read it too. Graham called it a photograph of a business, not a movie of profits. A single frozen moment. It answers one question at one instant in time. What does this company own and what does it owe? Own on one side, owe on the other, said Buffett. The gap between them is what is truly yours. Graham taught Buffett this in a Columbia classroom. 3 boxes: assets, liabilities, and equity. Assets are everything the company owns of value. Graham listed assets first in order of hardness: gold in the vault, buildings, trucks, inventory. Liabilities are everything it owes to others: loans from banks, bills from suppliers, wages due. Wall Street forgets that owing money is a promise kept. Equity is what remains after you pay everyone off. Assets minus liabilities equals equity. That's the spine. Graham called that leftover the owner's book value. Book value is your slice if the doors close today. In 1963, that slice was Buffett's whole question. Was American Express still worth more than its debts? Let's walk the page the way Buffett walked it. Start at the very top. Cash and equivalents. Cash is the most honest line on the page. It can't be faked the way profits can. Buffett loves a company drowning in real cash. Cash buys time, options, and survival in a crisis. Next line down. Accounts receivable. Money customers promised but have not paid yet. Useful, but a promise is softer than cash. Then inventory. Buffett eyes the goods on the shelves. Inventory looks like wealth, but it can rot. Fashion ages, food spoils, gadgets go obsolete. Graham distrusted inventory you couldn't sell fast. The salad oil tanks were inventory that vanished. That's why Buffett checks what the assets really are. 1 billion in cash beats 1 billion in dusty stock. Keep scrolling. Now the long-term assets appear. Land, factories, and heavy equipment the firm owns. Graham warned, these are hard to turn into cash. Then a tricky line, goodwill. Watch this one. Goodwill appears when one firm buys another dearly. It's the premium paid above hard assets. Sometimes it's a real brand. Sometimes it's hot air. Buffett trusts goodwill only when a brand earns it, which is exactly the See's Candies lesson. In 1972, Buffett paid far above See's hard assets on purpose. Why overpay? Because the brand printed cash for decades. See's needed little cash to keep growing each year. That kind of goodwill is gold, said Buffett. But goodwill from a bad deal is just a tombstone. So you've toured the asset side, as Graham did. Now flip the liabilities, everything the company must pay back. Start with current liabilities, bills due in 12 months, and suppliers, short-term loans, taxes coming soon, then long-term debt, the heavy anchor below. Debt is a promise that doesn't care how you feel. In good years, debt is quiet. In bad years, it bites. Buffett's rule, he fears debt more than he fears loss. A company can survive a bad year, not a margin call, so how much debt is too much? Use a simple ratio. Debt to equity, divide what it owes by what it owns. If debt towers over equity, the firm is fragile. Buffett favors a ratio well under 1, often near 0. A fortress balance sheet carries almost no debt. Coca-Cola and See's are fortresses by that test. Now the second tool Graham loved, the current ratio. Current assets divided by current bills due soon. Above 2 means it can pay this year twice over. Below 1 means trouble paying the rent next month. Graham wanted a fat cushion before he'd ever buy. These 2 ratios take 10 seconds and save fortunes. Buffett ran them on American Express in 1963. The salad oil loss was real, but it was survivable. The card business and travel checks kept printing cash. People kept charging dinners no matter the scandal. The balance sheet still stood after the storm passed. So Buffett poured a fortune into the bleeding stock. He bet that the page was stronger than the panic. Within years, the price tripled, exactly as the page said. That is reading a balance sheet like Warren Buffett. Now let's give you a checklist you can use tonight. First, find the cash. Is there plenty of it? Like Buffett, a company with real cash weathers anything. Second, look at the inventory and receivables. Are these assets real or are they about to rot? Third, hunt for debt. How big is the anchor? Compute debt to equity, Buffett wants it small. Fourth, run the current ratio for short-term safety. Above 2, you breathe easy. Below 1, you worry. Fifth, question every dollar of goodwill on the page. Is it a real brand or just a buyer's regret? Sixth, compare equity to the market price you'd pay. If you can buy below book value, Graham smiles. That bargain is the heart of the margin of safety. Graham hunted firms trading below their own cash. He called these nets. Cigar butts with one puff left. Imagine a firm worth $10 in net assets, yet its shares sell for only $6 each. You'd buy $10 of stuff for $6, a bargain. Even if it stumbles, the assets cover your downside. That's a balance sheet protecting you, not a story. Young Buffett got rich first on these nets. Then Munger taught him to pay up for quality. Better a wonderful firm at a fair price, Munger said. So the balance sheet works two different ways. For Graham, it shows assets you buy below value. For Buffett, it shows a fortress that won't break. Either way, you start with this one boring page. Now, a warning. The page can be dressed up. Companies hide debt off the balance sheet sometimes. Leases, pensions, and side deals tucked in footnotes. Buffett reads the footnotes most investors skip. The fraud usually hides where the eye gets lazy. So slow down at the boring parts. That's the edge. Watch inventory growing faster than the sales. That often means goods nobody actually wants. Watch receivables ballooning while cash stays flat. That can mean sales booked but never collected. Buffett caught these tricks in 1963 and after. The honest balance sheet has nothing to hide. It shows real cash, light debt, and assets you trust. That is the fortress Buffett spends his life hunting. Let's make this stick with a 30-second drill. Pull any company's balance sheet up right now. Find total assets at the bottom of the left side. Find total liabilities the same way on the right. Subtract. That difference is the equity, your slice. Divide debt by that equity for your safety read. Then ask the question Buffett asked about Amex. If the business shut today, would I still get paid? If yes, you may have found a Graham fortress. If no, walk away, no matter how exciting the story. That single discipline outperforms most of Wall Street because the crowd reads headlines. You read the page. Remember the C's lesson when goodwill looks scary. A great brand earns its premium for many decades. Remember the salad oil lesson when panic looks loud. A strong page survives a scandal, the crowd flees. Buffett built billions on pages like that one, not from tips, from a column of patient numbers. So this week, read one real page like Buffett did. Cash first, then debt, then the equity left for you. Run the two ratios. Question the goodwill, decide. Do that 10 times and the page stops scaring you. You'll see fortresses where the crowd sees only fear. In 1963, Buffett read one page and bought a fortune. The price had fallen, but the balance sheet held. He saw a Graham fortress where the crowd saw ruin. Now you can read that one page too and buy wisely.